Hello, everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. My guest today is George Milling-Stanley, who is the president of George Milling-Stanley on Gold Consultancy. Thanks very much for coming on the show. I appreciate it.
Thank you for inviting me.
Now, you've been around the gold market for a long time, so I'm very happy to have you here, and I'm interested in picking your brain a little bit because, you know, you've seen it since the early 70s until now. You were involved in the development, actually, of the GLD product. You've seen the success of that. Why don't you give me sort of a macro bird's eye perspective right now, not just of the market, you know, but also just the perception of gold as an investment vehicle. You know, it's gotten very, very popular. Is that sort of waning a little bit? Is it still there? I'll let you handle it.
I think that we're still in a bull market that began way back in 2001 when the price was down at about $250 an ounce. And for the first few years of that bull market, we went along quite nicely, going up about $100 a year, which was enough to generate investor interest, but not enough to give you sticker shock in the important consuming markets for jewelry and in China and India and so on. So it was a nice, healthy market. Then in 2009 and 10, we went up $200, which was a little fast. And then in 2011, the hot money came in and drove us up $500 in just 9 months. And you know, when a price goes vertical in any asset class, you know it's going to end in tears. And it did in gold. They took their profits and went away. So the hot money's gone. We're now back to, I think, a basic, fundamentally driven, solid market, which seems to be trading in a range between, about 1150 and maybe 1350, with at the moment the pressure tending to be to the upside because of what's going on in Ukraine and so on. So I think we're in a pretty healthy market right now. Once we really get momentum behind this and break out at the top end of my range, which I hope will take a while to happen, but I think it's going to come sooner than I want it to come. But once that happens, the hot money will come in again and take us to a new peak, probably above where we were before. And I hope that that doesn't happen for a year or more, but I'm afraid it might happen in a month.
In a month?
It might happen as quickly as that.
1900?
The hot money coming back in and starting to drive us up. No, I'm not seeing 1900 in a month. I'm just seeing the start of that process. It took them 3 years to do it before. And, you know, we're around about the same level where they started before, around the $1,300 mark. They did it fairly quickly last time. I think that the hot money will come in, maybe not until we get above 14 or 15. That would be nice, because that will be somewhere way towards the end of this year. And I think that would be healthier. The longer we build the base, the firmer the foundation for going higher. So investment is still there. The solid investment is there. The long-term investor through ETFs, through allocated accounts, whatever it may be, that's still there. There's no question about it. The jewelry is coming along quite nicely with China and India, the rest of Asia doing reasonably well economically. We're not got any economic disasters, no hard landing in China or anything like that. So I think the market's in a pretty healthy state right now.
Now you say the solid investor, but is this a particular class of investor? Because let me explain. You know, at the same time that we're seeing this bounce back in gold, and you're saying maybe very soon we'll see the hot money come back in, we're seeing a very, very strong market in equities around the world. In fact, we're 5 years into a bull market in equities. We've made new highs in the S&P. We've made new highs in the Dow Jones. Other markets have been doing, you know, decent, if not very, very good. Isn't that some sort of a competition for gold, number one? And number two, does gold just have its certain class of investors that are just going to go there all the time, regardless of whatever else is going on?
I think that maybe that was the case, that there was a certain kind of people who would always buy gold. I mean, there are people who will always have gold as part of a strategic allocation, maybe a 5% or a 10% allocation that's always there, and they hold their nose when the price isn't performing, but they're glad about the diversity that it gives them. They're glad about the relatively low volatility relative to other assets that it gives them. So those kind of people, I think, are smart investors. People who are putting a tactical overlay on when they're expecting the price to move up. That, again, is, I think, what we're starting to see right now. And to my mind, that is sensible. It's not a particular kind of investor. It's a mindset of investor. So that there are some institutions who take this view. There are some individuals who take this view, and the whole you know, range in between as well. But I think that the That's what I call the serious investor. Then there's the hot money that comes in from time to time, primarily hedge fund driven, no question about that. Momentum traders, trend following speculators. They're the people that took gold up to $1,900. They're the people that will take it up through there at some point in the relatively near future, within a year or two is my guess. They will come back in. But at the moment, I think that the market is pretty soundly based, and it's those solid, the people who have that strategic allocation and are prepared to make a tactical allocation on top. And ETFs have really just made it easier for all of those kind of investors.
Oh,
you can
no
now
question
do it
about
through
it.
the stock market.
Right.
It was exactly what investors who weren't involved in gold needed.
Yeah, people understand stocks, and
Right.
that's the vehicle that
And
they
it shows
can
up
use.
in their monthly statement from their broker as well. It's an easy way to do it.
Now, for a lot of people, gold, they consider it an inflation hedge, okay? But let's look at that argument. I mean, if you look at the price of gold right now, if you look at where it was in 1980, and in nominal terms, yeah, it went almost all the way to $2,000. But when you discount it for inflation, when you adjust for inflation, if you invested in gold back in 1980, and if you look at it now, or even at the peak when it hit 1900, you didn't beat inflation. So why does this argument
You're
continue?
still
on?
lagging inflation. I agree. I mean, the price would have to be at 2,300 or thereabouts in today's dollars to match the 850 we reached back in 1980. I agree with you. But I think when I talk about gold as an inflation hedge, I'm talking about the long term. And at my age, I can talk about the long term. I've been there for a good part of it, right? So I'm talking about over decades, gold tends to be a good inflation hedge. In the short term, not necessarily. But if you're looking over decades or even centuries, then it will tend to preserve the value of your capital. And that's really why, to my mind, that's really why the smart investor goes into gold. It isn't necessarily to make a lot of money, although for the last 10 years you could have made an awful lot of money in
Right.
gold if you were swift-footed enough. But it's not to lose money, and it's kind of to preserve the capital and to help preserve the whole value of your portfolio. That's really why the smart investor goes into gold.
Right.
There's a long tradition in this country of thinking that gold is just an inflation hedge. So if we don't have inflation, like between 1980 and 2000, say, we didn't have inflation, then you don't need to buy gold. I think that's mistaken. It's a hedge against dollar weakness. It's a hedge against geopolitical tensions. The fundamentals right now, the fundamental of supply and demand are growing healthier for gold, and they have been for quite some time. So it's a lot of different reasons to buy gold.
Now, I know you've worked very closely with central banks over the course of your career. And, I kind of joke sometimes and say, they're a great contrarian indicator. I mean, you recall during the 90s when gold was 250, 260, they were net sellers of gold. And then recently, over the past several years, probably around the peak again, they were net buyers. Where are they now? Is it fair to say you could look at them sort of as contrarian indicators?
I think that's a little bit harsh, Mike, if I can say that. I think it's important to recognize there are two very, very distinct constituencies of central banks. There's the advanced economies of Western Europe and North America that were economic powerhouses during the heyday of the gold standard from 1870 to 1970. And as a legacy of those days when they needed gold to back their currencies, they have huge gold reserves. At mark to market, on average, that group has more than 75% of external reserves in gold. Then there's the rest of the world, which are now the economic powerhouses, but were not during the gold standard. China, India, the rest of Asia, and so on, Singapore, Taiwan. They don't have that same legacy of the gold standard days, so on average they have less than 5% of their reserves in gold at mark to market. The sellers at the bottom were the Western Europeans. I agree that they're generally a good counter-cyclical indicator. They're not selling right now. Their appetite for sales dwindled when gold got up through $1,000, essentially. But what has been happening is that the rest of the world, led by China, Russia, Brazil, Mexico, Korea, Thailand, India, it's all over the lot, that what we used to call the emerging markets have been buying increasing quantities ever since this bull market began in 2000. And I think they're a good indicator. They're buying not so much because they're expecting the dollar price of gold to go up, but because they're expecting the international value of the dollar to go down. It did that from about 2002 until 2008, and then suddenly the world rediscovered the magic of the dollar as a safe haven. I still think that the dollar is a currency looking for something to decline against in value, but everybody else is better at depreciating their currencies than we are right now.
You know, that you raise an interesting point, because you correctly marked that time period from 2002 to 2008 when the dollar was declining. But then, ironically, right at 2008 on, when the Fed started to engage in all these extraordinary monetary policies, we had the financial market crash, and then other central banks as well, the ECB, Bank of Japan, which has been doing quantitative easing for 20 years now. Does it surprise you that gold isn't higher? Because this was the exact fear that, you know, the gold community had, that one day they would print money like crazy, the central banks, and there we had, you know, reserve balances in the U.S. go from 800 billion to 4 trillion, right? If you look at a chart.
Sure.
And so are you surprised that gold didn't go higher?
Not really. The rise up to 1900 was obviously predicated on all of that money creation that you're talking about. But I think the real deal is that we have not yet seen inflation come out in the statistics. Monthly CPI is still relatively benign and looking like it's going to remain that way. What we've had is a massive increase in money supply in this country and elsewhere in the world as well. But we haven't had the other shoe that Milton Friedman talked about, the other half of the Friedman paradigm. You have to have an increase in the velocity with which that increased money supply moves around in the market. The banks, the commercial banks, are basically happy sitting on larger reserves than they had before because they know we're in a serious tail risk environment. And because the regulators, whether the people trying to implement Dodd-Frank or the Basel Committee on Banking Supervision in Europe, are saying at some point in the future we're going to require you to hold a lot bigger reserves, but we can't tell you when or how much bigger. The banks will get back into their lending business once they have clarity on the regulatory front. And then you'll see the velocity, and then you'll see it coming up in the numbers.
It's also, you know, people's incomes are not really going up. So, I mean, the demand for credit, you know, if you look at the banking system as the real creator of money, the credit money, the demand for credit is just not there because a lot of people are not seeing a rise in income to justify taking on more credit. All right, so let's sum it up. You know, right now, a little bit of a trading range, I think what I'm getting from you, but getting close to the point where a lot of that hot money might start piling back into the market again.
Yeah, I think a good trading range to play, this 1150 to 1350. If we break out on a sustained manner above 1350, then we're off to the races, and I think everybody should be long.
By the way, somebody's got to teach these hedge fund guys how to buy when the price is down, right? Not when it's up. But
buy low and sell high, not a bad lesson.
Not a bad lesson. George Milling-Stanley, thank you very much. Pleasure to have you.
Mike, thank you.
That's it for now, folks. This is Mike Norman saying see you next time. Bye-bye.